Hello, this is Mike with the Netpicks Inner Circle. In this video, I'm going to walk you through some of the things that I've been doing in my own trading to adapt to the slow market conditions that we've been seeing over the past number of weeks. Yesterday's session, we actually saw a VIX reading below 10 at the close for the first time in a number of years. When you get this type of a low volatility reading, it often comes with very low intraday ranges, very tight ranges, very low volumes, and those are both things that we've seen pop up quite often here over the last few weeks. However, when you turn on financial media, they make it sound like a good thing. There's no volatility to worry about. We're in a never-ending bull market. That's good for long-term buy and hold investors. But for us as traders, those tight intraday ranges, the low volume, it just makes it more difficult for us to become active and get the frequency that we really would like to see long-term. So instead of just going to the sidelines, which I've heard from many people, I'm just going to wait, hold off until the market starts to pick up. Well, I disagree with that approach. I think that's the wrong approach because if you do that, you don't have any chance of making money. There are some things that we can do to adjust to these slow conditions, and I'm going to walk you through those over the next few moments. So if you take a look at the volume down here at the bottom, this is just a simple daily chart of SPY. You can see the volume for the second day in a row right around that 50 million share mark. That's less than half of what we typically see long-term, historically speaking, on SPY. So with volume this low, it just makes it very difficult, especially on the option side. For those of you that have been taking trades here lately, you know it's been difficult to get good fills. We've definitely had to pay up when we're trying to buy options, and when we're trying to sell options, we just can't collect as much, and that can add up to a pretty large cost long term. We're giving up a lot of profit potential because of the lack of liquidity. So long term, we'd like to see that volume pop up. That typically comes with a sell-off, right? So we haven't had any type of selling pressure here the last few weeks. You see the tech names like Apple, Amazon, Google, Facebook, they just seemingly are up every day. We need to see some selling. If we can get a day or two of selling, we should start to see those volume numbers pop up, and that would alleviate many of the issues on that side of things. The volatility is a different story. Let me switch this over to a chart of the VIX. I'm going to get rid of those indicators off of the chart so it's easier to see this. And I'm going to switch this. I'm going to switch it to a 5-year weekly chart to start. Because I want to paint a picture here. You start to talk about volatility being this low. What has happened historically speaking when we get to these types of levels? Well, here looking at this weekly chart, you can see, even if I zoom in, you'll still see enough on the chart to know that with our current reading at 9.96, this is right now near the lower end of the range that we have typically seen historically. What happens after we get to these readings? Well, take a look at these short-term spikes in the past. If I go left to right, you can see anytime that we get down this low, it's typically just before a decent spike to the upside. So what does that mean for us? Well, it doesn't necessarily mean that this market has to turn immediately. This volatility could continue to stay low for an extended stretch. So we don't know when it's going to pop, nor do we know what catalyst is going to cause that VIX to pop. If we did, it would be easy to trade, right? So we just know going forward, the strategies that we use, we want to make sure that we're using those strategies that would benefit from volatility expansion, right? I would love, as an options trader, I would love to sell options all the time. Sell some spreads, get that time decay working in our favor. The problem there is when I sell an option, I want that to get as cheap as possible so I can either let it expire worthless or at least at the very least get the premiums to decrease where I can buy them back cheaper and book the profit. The problem there is if volatility expands, it's going to cause those options to increase in value. So if I just sell options all the time like some people teach, I completely disagree with that. Okay, if the volatility is decent, if the market's going to allow us to sell premium, I would definitely be open to doing so. But I don't want to back myself into a corner and just limit myself to one style. If the volatility is low, and we can see here historically, when it gets this low, it tends to pop. It tends to expand. I want to put on strategies that would benefit from that. So for me right now, I'm trading a lot of long calls, long puts. I'm trading a lot of long vertical spreads. Those are strategies that will increase in value as volatility expands. Right, so that's really what I'm doing in my own trading. And you can extend this out even further. Let's just switch this. Instead of looking at a weekly chart, we can take a look at a monthly chart. You can see the same visual just on a bigger scale. We are down near the lower end of the range. So in order for this market to normalize, it's going to take a pretty nasty move lower in equities to get some volatility back into this market. So even though it feels like this is the new normal, we're going to be stuck in a low volatility environment permanently. That's not the case. It's never been the case historically. It'll not change going forward. Right? We know it won't, because as we talked about earlier, if we have no volatility, there is no market. The volatility cannot go to zero. So we just have to continue to be patient. And as a trader, we know that that's the most difficult thing to do, right? I want to be active every single day. I'm a full-time trader. If I'm not active in the markets, it's very easy for me to lose that discipline. At Netpicks, we're big believers in taking a mechanical approach, having a defined set of rules in place that guides us day in and day out. Well, the problem in a very slow market environment, it's easy to lose that edge. Right? It's easy to say, hey, I'm not going to come in and check the markets here this afternoon. I'm not just going to check my swing trades because the market's slow. I'm going to move on with my day. Let's go play some golf. Let's get out of the office. And then all of a sudden, the market's lulling you to sleep. That's what it wants you to think. That's what it wants you to do. Lose your edge, lose your discipline, and that's when it's going to start to move. So it's really crucial to continue to stay with that disciplined approach to your system. Continue to come in, check your trades a couple times a day, like we teach in our systems. And then ultimately for us, the frequency will come. Right? We know out of this move, we will get a big breakout. If we just go to the sidelines and don't have any activity and don't have any trades going, right, we're going to potentially miss out on that move, because things can happen, things can change in the blink of an eye. So I definitely want to continue to be active. Yes, I'm going to be patient. I'm not going to try to force things. I get it. We all have monthly goals that we want to hit. But if you try to force trades, that's oftentimes when the mistakes are made, right? I can't force the market to do anything. All I can do is take what it's giving us. And right now, it's clearly giving us the signal that it's time to practice patience. It's time to really be conservative, be cautious with your approach. Now, what does that mean? What is being cautious? What does that mean as an options trader? Well, there's a couple things that I've been doing personally. So far this year, I've been trading with around 50 to 75% of my normal position size. I have not traded 100% of my position size yet this year. The market just has not given me the green light to do so. Right? So what I recommend that you do is either cut back on your size if you can. If you're already trading multiple contracts, you can do that. If not, if you're trading small size to begin with, you can go ahead and start to utilize some vertical spreads. Following the criteria that we teach, you can typically reduce your costs by 30 to 50% using the vertical spreads. They're also more conservative trades because they tend to react slower to changes in stock price. So in a slow environment, it just allows you to stay active with less risk. So for many of us, that's a good thing. Now, as far as your watch list goes, we're big believers in focusing in on a small watch list of products. Okay, many of you have heard us teach on that. So most of our students start out with a list of between 12 and 20 products. In my opinion, I think you can expand that list out by a few additional names right now. That doesn't mean you want to double the size of your list and go from a list of 12 names to 24 names, but adding 4 or 5 new names is definitely doable. What that does for us is it allows us to spread our risk and get more diversification. There are still areas of this market that are moving. We've seen some movement in commodities, in metals, in some of the individual stocks. And we just have not seen the broad-based market movement across the board. So if you add some diversification in there, if you add 4 or 5 new names, it just allows you to get more exposure in different areas of the market without necessarily tying up more of a time commitment on a daily basis or more capital, right? Because for us, because the market is so slow, I've got a list of 26 products. That's near the upper end of where I want to be. Anything above where I'm at now, it just becomes too much for me to track on a daily basis. But I'm willing to trade that many names right now because it's very common for me to have positions on in less than half of my list at one time. Right, so you can afford to add those additional names because the market is slow. And when the market does start to pick up, which it will, we can always scale that back. If it's too much, if you go from 12 to 16 names, if it gets too much, we can always dial that back down the road. But that additional diversification right now is crucial in my mind. Even if it means you're taking more very tiny positions or positions with spreads, that is still a good approach. You still want to have the additional exposure right now across multiple different products and multiple different sectors. Okay, so those are some things that you can keep in mind here given the current conditions. So if we mention that the market will break out of this range, it will. We're going to get into some more volatility in the very near future, in my opinion. What are some signals? What are some signs that we could look for that things are ready to break out? Well, if we go back to that daily chart of SPY, one of the things that you can take a look at, you just take a look at the sizes of these daily candles. Let's just keep things very basic here. Notice the difference between the sizes of these candles over the past couple of weeks and compare that to what we've seen historically, even just going back over the past couple of months. You'll notice that the ranges have really contracted. So if we start to see those ranges expand a bit, the sizes of the candles expand, and I'm not just talking for a day or two, I'm talking about consistently over a week or two, that's going to be a signal to us that things are ready to break out, and that could be the market's way of giving us the green light to get a little bit more aggressive. I would also love to see the markets close near the lows of the day. We saw a glimpse of that here today. We almost closed near the lows. We had a quick rally in the last 10 minutes of the session that took us off of the lows. But what I want to see here, if we're going to break this really strong uptrend that is in place, if I zoom in, I want to see these daily candles with some closes right down near the lows of the day. That would indicate to me that people are willing to hold short positions overnight. They're not just covering into the close every single day. Right, that would cause some fear to come back into this market with some conviction. So again, some closes near the lows of the day. Ideally, a session that opens higher and then closes near the lows, that's a perfect scenario for us. That really indicates that there is a significant turn taking place. I'd like to see some volume behind the move. So that's what I'm looking for on this daily chart. And then intraday, if we take a look at the internals, many of our current students have heard me talk through this on a daily, weekly basis. I like to look at these charts to see how strong or weak the market is. You can see that the internals today were pretty mixed. On a volume ratio in the upper left-hand corner, I'd like to see that number at -2 to 1, -3 to 1. I'd like to see some volume come in behind the move on the downside. So far, any type of selling pressure that we've had lately has just been a springboard up to new highs. We have not seen the conviction on the downside. So I'd like to see one of those sessions where we just kind of fall apart a bit and we see that volume ratio at -2, -3, -4 to 1, indicating that there is strong volume behind the move on the downside, more volume on the downside than the upside. On the advanced decline line, I'd love to see that number consistently at -1,000, -1,500. That would indicate broad-based selling across the board. We have not had much of that lately. It's been very, very mixed. Even when we've had these strong sessions, it's really been strength in one key sector or a handful of key names. We have not seen the broad-based movement in either direction here of late. So I'd like to see some strong or weak readings here on the advanced decline line. I'd also like to see some strong sell programs kick in. For us, we use the tick in the lower left-hand corner. I'd like to see one of those sessions where we start to get multiple -1,000 tick readings, where we get multiple sell programs throughout the day. That would indicate to me that we're starting to get some conviction on the downside. We have not had that now in months. So if I start to see that over a period of sessions, that also indicates to me the market given its sign that, hey, it's time to get more aggressive and ramp things up a bit. I mean, intraday, you can see this 5-minute chart. Today is one of those sessions. Today, at the time of this recording, it's May 9th. I mean, you can see on this 5-minute chart, we saw a breakdown this afternoon, right down near the lows. We got into 3:30 or so, and I'm sitting there saying, well, this could be the day. This could be day one where we get the close near the lows. Unfortunately, you can see what happened. The last 10, 15 minutes of the session, we got that rally up off the lows. So it's still, we get small little glimpses of some selling. It just does not carry through for more than 30, 60 minutes at a time. If we can get one of those sessions where it completely falls apart, we get some sustained selling, that's an indicator to us that, hey, we can ramp things up. When I say ramp things up, what I'm talking about there is increasing my position size, go back to 100% of my normal position size where I have not been now in a number of months. Maybe potentially look at more long puts just to get more aggressive and take advantage of that volatility. All right, so the nice part about options, we have tremendous flexibility. We can play around with position sizing very easily. We can utilize the spreads. For me, I've been trading a lot of spreads on the upside. Okay, I want to be cautious here. With the market so overbought, I don't think it's time to get aggressive on the upside. Most of these stocks and ETFs have already made their big moves on the upside. I don't want to continue chasing that. right? So I'm going to be more conservative there with smaller size, with more vertical spreads. And then on the downside, if and when we get that type of movement, I'm going to get more aggressive, more long puts, more aggressive position sizing, things like that. That's what we're going to do to take what the market gives us. And we know long term, it's not uncommon for me to look back at the year and see that I made all of my money during a couple of blocks of time. Right now, so far this year, it has not been a broad-based market move. So it's about that. It's about that survival mode that we're in right now. We're trying to grind it out because we know we will get a big move and we'll be able to make up some ground quickly. We just have to be patient for that to happen. We want to preserve that capital so when it does happen, we can get more aggressive. So those are some things that I'm looking at here, big picture wise. We know the volatility will increase. Until that happens, let's be more conservative, be patient here, take more smaller position sizes, more vertical spreads, and then when we do start to see some of these signals that we just walked through, when the market does start to break out a little bit, that's our green light to really ramp things up. So it's frustrating. I get it. We all want to be active and we all want to see the big volatility. It's just we can't force it. We have no control over the market from day to day, so we just have to continue to practice that patience, continue to take what the market gives us, and in the end, we will absolutely be fine. So, as always, if you have any questions on this, feel free to send me an email to mike@netpicks.com. Be more than willing to connect and walk through some of this in more detail. So I'm going to go ahead and wrap this video up here. Fingers crossed, see if we can get some volatility here over the next week or so. That would be a welcome sight for all of us, day traders, swing traders alike. So happy trading, everybody, and we'll be back with you with our next video here in the very near future.